is up, ladies and gentlemen? We are back. We are live. It is the Freight Coach Podcast, the top podcast in transportation, coming to you guys every single weekday, 8:30 a.m. Pacific, 10:30 Central, to break down some industry headlines. But most importantly, you guys provide some actual insight into what you can do with all of this information. If this is your first time tuning in, welcome. This is the real side of freight, ladies and gentlemen. And I do say that before every single show. And what I mean by that is I only speak with transportation professionals, because at the end of the day, I want to talk to the right individuals who have done what you're looking to do, or who are currently doing what you're trying to achieve, so you can take that information, apply it, utilize it, and see a meaningful difference in your business and your life. Happy Monday, everybody. I got a very special guest for you guys here today. We're going to be talking about all things equipment financing, where things are, where are things trending. Is it just a giant crapshoot like it was for 2025? We have no idea, but the guy who is on the show today, he definitely does. So I have my good friend James Currier with Finlock back on the show. James, thank you so much for taking some time to join me today.
Jolly, always a pleasure, man.
No, dude, I love talking about this, because it's like I'm sitting out here, as I'm sure a lot of people are, and I'm sure a lot of your clients are, like, at what point are we going to have something to be able to, like, accurately predict before going through and investing or reinvesting resources inside of our company? Because it's like, I think it's safe to say, from the freight market perspective, from the people who are actually moving freight and are not trying to sell technology to individuals using freight, I think it's going to be continued to be muted here for a little bit. I don't see any sign or early indicators that there's going to be a rapid spike in volume coming up here.
You know, that's the general impression that I've got. And based on the market intelligence coming out recently and what I anticipate coming out this week from the Fed, they've got, I think, 13 speeches that the Fed does this week with a lot of new data coming out. So perhaps next week would have been a more appropriate time after the data comes out to have me on the show. But listen, I do my best with the crystal ball that I've got. And based on the data that I'm seeing, there's nothing outstandingly remarkable that's coming out that suggests that there's going to be a massive boom.
Yeah. And I mean, so you guys, obviously you guys do financing down here in the States as well as up in Canada. And so you guys have one of the more broad overviews of kind of what's going on out there in the freight market. So just like, let's start up in Canada as a whole, for like your intra-Canadian carriers that you are working with. How have things been kind of the last quarter? Where are they all sitting right now? Like, are they, on the edge of their seats? Like, is there any clear thing that they're kind of waiting on to kind of decide on? Or is it pretty much like they've thrown their hands up in the air?
At this point, stability would be a good enough indicator for fleets to start replenishing at a greater rate. The challenge right now is that there just isn't a whole lot of stability. The job market numbers that have been coming out recently, particularly for December and for all of 2025 in the US, are not outstanding, to put it mildly. It was the worst jobs report since 2020, and then we went through COVID. There's really no semblance of consistency throughout the market right now. Best case scenario is at some point in Q1, the Fed lowers the interest rate, and that gives the overall consumer a little more confidence that the market will start to reinvigorate itself.
I look at it, because obviously I saw the jobs report as well, and I live in reality, not hyper pie in the sky on stuff as well. Mm-hmm. And that was a very kind of shocking thing to me, is I'm like, well, hold on a second. I thought everything was going great, right? And again, I call balls and strikes on the show no matter what. Yeah. Do you think, from your seat, James, the reason why the jobs report was not as glamorous as some people are touting is the overall investment in technology and automation that trucking is kind of in, and kind of like the overall economy is? And I look at it as again, I'm not picking on C.H. Robinson at all, but like their stock price was up like 70%. Like on their last earnings report, and there's a direct line item that shows that it is because they severely lowered their overhead by letting go a lot of people because they have invested heavily inside of technology. Do you see or hear anything like that out there as well? That could kind of be the reason why jobs reports are down is people are just automating it.
Automation and AI certainly have a role to play in a company like that. When you can replace man hours with technology hours that are ultimately usually fractions of the time, and so much more efficient. Those companies are going to take advantage of those opportunities to both reduce cost and increase revenue.
Mm-hmm.
That being said, the average trucking company doesn't have that opportunity now. They can introduce technology in certain facets within their operations, but you still can't replace a driver with technology.
Mm-hmm. No, I agree with that. And, obviously being a small business owner myself, I'm constantly looking at how can I pack a larger punch out there, right? Because I think most small businesses and most businesses inside of transportation are, like, how do we stand out in the crowd? How do we pack a larger punch? How do we secure more market share without, because like as somebody who's trying to build their business, it's like, it's kind of the cart before the horse is where we're at right now is it's like, yes, we're chasing more volume, but like, if we get a ton more volume, how fast can we ramp up behind it in from a headcount perspective? And it's like, we're looking at so much different automation tools that are at our disposal, because it's like, I kind of have this wild idea that like I could possibly build $100 million freight brokerage with 10 people. Like, I think that automation tools are out there right now that we could do that. And I know how insane that sounds, but it's like, I think a lot of trucking companies, even on the smaller side of the fleets, that they should be looking at that, right? How fast can we process paperwork? What can we do to really clean up our operations? Because I'm not looking to automate sales by any means. I'm looking to automate everything behind the scenes that is not customer or carrier facing.
I really have the feeling that 2026, 25, I mean, challenging by all means for just about everyone across the board, with the exception of some major shareholders and stockholders. I have a feeling that 26 will allow people to really set themselves apart. It won't be the fleets that buy the most equipment that really come out ahead. It'll be the ones that buy the right equipment with the right capital structure.
Yeah. Do you think a lot of people are also looking at how can they increase the longevity of their equipment that they currently have? Are they trying to, because like, I think, in this, to kind of like preface it is, I look at like interest rates right now that are out there as a whole. And especially, maybe I should have paid a little bit closer attention. We should have scheduled this for next Monday, but I look at it, and because like, I think that is one of the larger things that needs to happen to really spurn consumer confidence in everything, because of, the cost to acquire capital needs to drop, right?
Mm-hmm.
Like it has to, for the majority of people, I think, to feel confident in taking that risk and buying anything new. Do you see, or do you think that carriers might just be like, no, actually, how about we just refinance our loans right now? Let's keep our current equipment. Let's try and extend the longevity of it. Let's just refinance it, as opposed to going out and trading in and acquiring newer equipment.
Refinancing is one option. Ultimately, that will cost you more capital in the long run to refinance, and it certainly is an option, depending on how your lease or loan was written originally. Yes, it's an option, but not one that we typically like to explore unless you're looking for additional capital to free up for other resources. The primary points that we like to really drive home is the difference between new and used is the difference between uptime and increased cost and maintenance. So if you want more uptime, you buy new. You need the capital to do that. If you're okay with the capital that you've got and you can afford used and you've got access to your own shop, then maybe that's the way you do it. Either way, there's a way to structure new versus used, and long-term versus short-term, that will be of benefit to an individual customer, being the trucking company, from my perspective, that will best suit them at that particular point in their history.
Do you think any of the OEMs, or, for the people out there who aren't, like the Kenworths, the Freightliners, the Peterbilts, do you see, if there is no meaningful change at the Feds dropping interest rates, do you think any of those companies might start offering more competitive new purchase interest rates on their equipment, just to like really get it up and running? And because to me, it's like, based on the data that I saw, that December had a massive purchase. It was 42,000 units or whatever that was sold in December. Do you think that the OEMs and the truck manufacturers and the trailer manufacturers might change course a little bit if there is no meaningful drop in interest rates out there?
That's a great question, and one that's very hypothetical, of course, because I'm not an OEM. But from my perspective, just trying to think through your question, if you're an OEM and you're down, most OEMs were down somewhere between 25 to 42% year over year in manufacturing units in 2025. You've laid off a ton of staff without some significant uptick month over month, year over year in purchase orders. Are you bringing back staff, or are you just delaying manufacturing? If I'm the OEM and I'm the person in charge at the top, you're probably building as fast as you can with the people you currently have.
What goes into like from your seat right now, James, with everything kind of hinging on this, where do you think that do you think that there's going to be any meaningful change, or is it going to be just another slight decrease? Do you think it's going to be a tapered down approach to it, or do you think it's going to be, this is going to be the next drop, and that is probably where they're going to hold firm here? And again, I know this is hypothetical, but like, you have access to a lot more information than I do, and you've seen this stuff, right? You've seen the ramp up and the ramp down of interest rates and everything else. And I know the current administration is very much kind of going after that right now. President Trump's been very vocal about reducing interest rates as a whole, and he's also starting putting some I believe, I don't know if this has happened yet, but they're really trying to cap credit card interest rates as well here, just to try and bring some form of consumer relief out there. Now, do you think that there is any indication that this could continue to go down and they could continue to reduce interest rates? Or do you think this is like a one-time thing in Q1 and then they might just hold firm here for a while?
Great question. They do have a rate announcement coming up. I'm not sure if you saw the news over the weekend, but I believe it was Friday night. The government has announced that they are, I believe, either suing or deposing Fed Chair Jerome Powell.
Okay.
So it's making the Fed highly politicized, and they're a unique standalone organization that should not be controlled by the federal government. And essentially, that's the route that it's going now by President Trump suing Jerome Powell. So makes it a little more complex, but I think he will ignore the suit. I don't think he will change rate in the next announcement, given the job numbers. CPI is typically holding steady, but this week's data announcements and info announcements will have significant impact on the decision that's being made soon.
Mm-hmm. Were the tariffs put on? Because it's seemingly like they were kind of like, again, I should have pulled this information up before the show, but like, was that like with the current lawsuit out there? Because it went to the Supreme Court. Nothing seemingly was announced on Friday that like they were going to be able to continue. Do you think that may, and again, complete shot in the dark, do you think that could have been a reason why they that kind of spurned some purchasing confidence is they're like, hey, if there's a gap in the window where like tariffs are down, let's go out and let's buy this right now. Let's get these orders in now so they can purchase all of those raw materials for manufacturing.
Absolutely. The OEMs absolutely took advantage when the tariffs were first announced. A lot of raw materials were purchased both domestically and internationally in advance of the tariffs actually hitting. But I mean, the OEMs have all gone through all of the stock that were purchased pre-tariffs.
So what's a strategy do you think that, maybe you're kind of advising your clients on right now is, like, again, and this is tough to really even put an action plan out there, but I know that I can't be the only one thinking who might be like, how do we actually go through and increase the longevity of our equipment? Or like, what can we do here this year with so much kind of hinging on interest rates as a whole? How can I like put some numbers together on how, like, building out my fleet? If I'm looking to go and buy or something like that, maybe my equipment's reached its life cycle and it's time to go in there. What are we looking at for this?
So, and great question. From a lender's perspective, the underwriting process, that's the process that we as lenders go through when we're making a decision as to whether or not to actually lend to a particular client. Historically, it's been predominantly financially related. Now, it still will be going forward. In 2026, things like cash flow stability will be of the utmost importance. A mixture of freight coming from different areas in different markets. Driver retention will be an absolute game changer. And maintenance discipline. How you're maintaining your current fleet is really important to lenders now. We want to take a look at not just the financial factors, but how fleets are being maintained. And when I walk into an office, I'm paying attention to how that office is kept and are the people happy? Are you seeing a huge turnover in your office staff? Or, is your driver retention at 50% year over year with a base of 100 drivers? That is a huge cost occurrence when you're talking about trying to maintain your fleet and the stability of your operations. Those are the things that are going to be important to lenders in 26.
What are some, do you have any like examples of, maybe clients of yours, obviously you don't have to mention any names, where it's like,
I mention names.
Okay. No, I was just saying, like,
No, I won't do that.
Such a vast improvement over the years. Like, they've taken it where it's like, hey, you know what? Access to capital might not have been the easiest over this time frame, but like, we've cleaned up our operations. We've bought technology. We've automated that. We've increased our, or decreased our driver turnover. They've focused more on operational excellence over these last couple of years, and how they've taken that, and now you're able to work with them and maybe get them some better rates or get them something on that to improve their cash flow.
One of the biggest factors I look for personally, and this certainly doesn't cover everyone, but from my perspective, things like transparency are so important. We know we've been through ups and downs in the freight markets before, in the trucking markets. We know that people have ups and downs. Trucking is very much feast or famine. That's how it has always worked. That's probably how it will always work. We know that trucking companies go through tough times. I need to be one of your first calls when you're having a tough time. If you are, requiring additional capital, if your balance sheet is out of whack, if your operations are not succeeding for whatever reason, and you're having financial difficulties, you need to talk to your lender in advance of needing help so that you can work together to avoid catastrophe. That's the biggest issue for me. Is I don't want to hear about you needing help 6 months ago. That doesn't allow me the opportunity to actually help a trucking company in any tangible way. I need to know about when you need help today so that we can work together over, X amount of days, weeks, months to right the ship. We're here to help legitimately, but I can't help if I don't know you're going through issues. And that is why a lot of lenders have started asking for quarterly financial statements and audited financial statements, because the transparency isn't always there. And it's a human reaction to not want to talk about financial difficulties. We get that. I get that. Nobody wants to talk about going through a hard time, but you have to. It is a reality of business that some years you need a reset, and some years you're going to have more steak than hot dogs. That's how it goes.
Do you think people like, I guess what is the right time to wave the white flag where you're possibly not setting off alarms? You know, like, have you seen that kind of that fine line of that perfect, like, hey, this is when you should, as opposed to obviously waiting too long is very clear that's a big red flag. You should not wait. Like, if you're having financial stress inside of your business, you should be making that call. But have you ever seen anything where it's like, hey, these guys handled it the right way? They had, 2 months of drop in revenue, and then that's when they came to us.
Yeah, I mean, it's different for every company. Jolly, your questions today have been outstanding, probably better than any other podcast I've ever been on. And I think this might be 7 or 8 now. Yeah. So I appreciate you thinking outside the box on these. The way I like to think about it is every company should have projections going out 3, 6, 9, 12, 24 months. And they should be based on how you're currently doing, what the market is doing. All of this now, the financial modeling that is available to the average person, it's outstanding. There's no reason why every company shouldn't be modeling what they're going to be doing based on current operations and financial statements a year out from now. Particularly given the current market, you need to be trying to project what's going to be happening for your company and your people at least 6 months. So if your models and your projections are showing downturn for whatever reason, fantastic opportunity. When I call you, you got to say, James, I don't know what's going on, but my model's showing a significant downturn in working capital. What do you think we should do here? It's time to sit down at that point and say, okay, there's going to be some hiccups and troubles. Perhaps look at A, B, C, or X, Y, and Z, or Z, sorry. We sit down and talk about your potential options given the circumstances at that point.
Yeah, I'm bringing up a lot of this stuff because just like everybody, all of my insurance raised this between 25 and 26 in not a small number. Like my commercial auto policy that I have for my business was up like 8%. My health insurance, it was like a 70% increase. And like a lot, right?
70%.
Yeah, dude, I was like, no joke, I was paying last year, like, to round it up, I was paying like $850 a month for health, vision, dental for myself and my family. Now going into 2026, it skyrocketed to $1,450 a month. So it's like if we're just.
That doesn't leave the average consumer with a whole lot of confidence when you're for an average family in the United States. There's not an extra $500 a month.
Yeah. And dude, and I'm sitting here looking at it as I'm like, I'm a small business. $7,500 goes a very long way just in insurance. And then in my auto insurance, like I would say overall, I'll round up, I'll say probably $9,000 my insurance alone raised from 25 to 26. Because it was like another $1,200 on the auto insurance. I'm essentially paying like $670 a month now. It raised about $100 a month out there. And that was it. So it's like, I'm looking at a lot of this stuff inside of my businesses. And now I'm trying to think about all the carriers and people who have physical assets that are like at their life cycle. They need to do something. Otherwise they lose their revenue, because it's like, I'm sitting here and it's like, I wish I could say, James, it was just as easy as, just go sell more, because that's everybody's go to. Oh, just go sell them. I'm selling every single day, right? And it's like I'm out here and I'm trying to think, how can I keep my balance sheet healthy, which it is, right? And we're fine internally, but like, I know if I'm going through this, I know I'm not the only one. And people need to uncover cost savings in any way you can, because in the real world, you guys, it's dollar in, dollar out, right? As 50 Cent said, you got to make $1 out of 15 cents. And that's how it is inside a business. Like you do you have to get an ROI. And when expenses are going up, fuel, I know people are pointing to that right now, that it's dropped a little bit here overall, but like maintenance, everything has gone up on these trucks. How are people going to continue to make it through 2026 if interest rates don't drop, if these things don't happen? Because there's a lot of what ifs out there right now. And that's what I hate the most about all the media and everything else is there's a lot of what ifs. And you know what? Yeah, Wall Street might be doing great, but Wall Street is not Main Street. There is a very large disconnect between Wall Street and Main Street.
The best fleets in 2026 will be excruciatingly boring on paper and deadly in execution.
Yeah, I like that. Excruciatingly boring, but deadly on. Dude, I love that. You should
that's your soundbite for the day.
Put that behind you. Put that behind you. We need that. But no, dude, it's like I and this is why I love having you on James. Is like trucking has such, every business, every industry has a very high failure rate for companies, right? No matter what. Yep. There's, I think, less than 9% of businesses make over $1 million a year in annual revenue. Less than 9%. Yeah. So, again, like it is a very, and then especially if you're going to go out there and you're going to own equipment, you're going to own buildings, it is a very capital intensive thing. And that's why it's like people's desire to borrow money and refinance, I think is, again, because it's like, I'm trying to work with my CPA at all the time. So I'm like, hey man, how do I play the game here? Right? Like, how do I play the game to get to free up as much capital as possible? Because it's not as easy as like, oh, I'll just go out there and raise my rates to everybody. It typically doesn't work out well in a down market.
No, it doesn't. But if you're looking for stability, and I think that most people are right now, stability is something that hasn't been available to the general market in 24 months, at least in the freight market. Things like full maintenance leases. Think outside the box. You don't necessarily need to own the equipment. If you're not trying to arbitrage the market and make fractions of a penny, and you've got solid contracts in place, full maintenance leases are a great option for any company that just needs to get through before they want to make major purchasing decisions.
Mm-hmm. Do you think that with the amount that truck prices increased post-COVID, do you think that has still driven some consumer, I guess, like they're not confident in going out and buying anything at this point because they might be trapped under an insane loan and they're underwater in their equipment?
Yeah, I see it every day. Lots of folks still underwater, particularly, and it will be probably 2028 before we see those loans mature and these companies get out from underneath them.
Yeah, that's, again, I wish there was a golden horseshoe out there for everybody. But again, we live in reality on this show, and it doesn't matter what people say.
I know where it is, bud, but you're not going to like finding it.
Oh, that's awesome. James, thank you so much for your time today, man. How does anybody reach out to you guys over at Finlock to find out more?
Listen, always a pleasure, Jolly. Thank you so much for having me on again. Reach out to me on LinkedIn. That's the easiest one, or james.currier@finlock.com.
Perfect. James, I appreciate it. That's going to be it for today, ladies and gentlemen. Hit up James, hit up Finlock. Even if you have questions, James always been great to our audience out there for people who just need somewhere to start. They need somewhere to turn to because they might not be getting the right information out there. Hit up James and his team. They're always more than happy to help. That's going to be it for today, though, ladies and gentlemen. As always, if you got value in what you heard and you're not subscribed, subscribe to the show, you guys. And if you're feeling ambitious, rank it on iTunes and Spotify, because if you're seeing value, your network will as well. I appreciate you guys. I love you guys, and we'll be talking to you soon.
Came back with a bang, window down, yelling out. money